All right, welcome to another episode of the Weekly Notebook Review. There's a little Fed announcement happening, so if you wanted to hear all about calls or conviction or people figuring out what this next narrative is, I'd go listen to another space because today we are solely focused on the data point that is what the Fed just or is about to announce or is announcing. Because that's all it is. It's just a data point. That's how your process should be. In fact, when we scheduled this, I didn't even really realize that this was literally 2 p.m. on FOMC day. And then I realized it on Sunday, and I was like, no, this is a great opportunity to just reiterate the point that our process is all about the full investing cycle, right? So it's less about the why as to why the Fed might do X, Y, Z, 50 basis points, 75 basis points, no hikes, no pivots, what have you. It's more about when is something happening, and where are we going from here, and where did you execute? So just wanting to welcome some new audience, the new audience on YouTube and on our Hedgeye.com website. This is the first time that we've live streamed both basically the Spaces session as well as my screen. So kind of charts that I have pulled up and whatnot. So if you're not watching or kind of don't have it pulled up.
I think we lost Robert for a sec, but we'll wait for him to get back.
Hey Jimmy, can you hear me, buddy?
I can hear you. Welcome
All right,
back.
sorry about that, guys. I think when the old Madre called, it kicked me out of Spaces there for a minute. So
It was Jerome Powell, Robert. Everyone got too excited.
Well, welcome again. I just wanted to thank everybody for jumping in. Again, this is going to be a lot less about the FOMC meeting and a lot more about things that are in the notebook and the longer term full investing cycle. So again, Jimmy, thanks for jumping up. Gavin, I don't know if you can folks love to hear your takes and the calmness out of your voice. But again, I mean, three things for me today that we're jumping out, and we can get to them in any really order, Jimmy. But one was just, Fed's data point. I was laughing at myself or laughing at kind of Twitter Spaces last night. There was multiple ones in preparation for the Fed. One in particular said that it was this Fed meeting was the most important one of our lifetime. I think that's a bit of a grandiose statement. And if you're considering this to be one of the biggest moments of your lifetime, I really think you should probably reconsider the narratives that you're following and the things that are impacting your investing in the full investing cycle and that kind of thing. So, to me, again, this was really just a data point. I didn't even realize this was, I mean, I knew FOMC was Wednesday, but when we scheduled it, it wasn't really even on my mind. So that should really tell you the impact of this Fed decision and the FOMC meeting today. It really impacts my investing strategy very, very little, and it's really just one data point, right? So it's a new data point into the old system. Richie's crunching that over. I can see him at his desk right now. He's putting these numbers into into our nowcast models and et cetera here at Hedgeye, and it's going to be fun to see what how it plays out, whether it influences anything in particular. Really, I think for me, it's going to be what are the upcoming what are the future rates, kind of like what are the expectations there, right? And sort of if you saw a chart today, I think it was in the deck, I believe it was. One second, if you but there was a very powerful chart today. I was either there or Hedgeye tweeted it out. Hedgeye might have tweeted it out about basically, the expectations is continue to increases all the way up to almost call it 6% in May, June timeframe. So, I think the difference between, again, 50 or 75 today, Powell, this is really the only tool that he has in his toolbox to try to fight inflation. And that's kind of about it, right? So if we think along those lines in terms of expectations, and then think about the nowcast model, we've got quad 4 staring us in the face. And the weekend work, basically, that was the biggest thing that was reiterated to me, was the fact that we have, if you look globally, whether it be the FX markets, European markets, Asian markets, commodities themselves, pretty much everything is pointing towards, quad 4 on the horizon and currently in quad 4s. And you all know this. So, the other data, other point I wanted to kind of, speak about today was more about, this bear market bounce could be considered in two ways. A lot of folks are trying to figure out kind of the timing on shorting it, right, and getting back on the short side. But I'd also reiterate anybody who's new, either who's new to the Hedgeye process or new to this space of session, to think about this as clearing out some of your long portfolio. So if you're still long some of the mega caps, some of the small caps that have bounced here, take advantage of that and really reassess, because this is what we're seeing on the horizon here is a pretty deep winter coming, and again, multiple quad 4s. We're just in the crux of one here. We've got a quad 4 in Q1, another one in Q2 here that's in the nowcast model. So to me, this is a great opportunity to either buy some puts, use the derivatives market to help abate any of the kind of potential losses that are on the horizon, because a profit recession is likely kind of out there, especially as they report Q4 earnings and Q1 earnings in the next few months. So Jimmy, I haven't even seen what was the rate? Was it 75 bips?
Yeah, we got 75 bips. Cool. Some incremental new language. I haven't really focused on that. I'm sure people want to hear what Powell has to say at 2:30. But you're
yeah, just so I know what the heck you did. Awesome.
Not that it matters.
Yeah, right? I mean, not really.
Focus on the cycle.
Yeah, and again, that's sort of the third data point, right? To me, Jimmy, and Coach reiterated this morning, is that it's really about the cycle, right? The timing of the cycle, timing the markets isn't certainly not what we do, but timing the cycle is really important. And there's some people, some people I've gotten some DMs and even in the macro show, Q, they're like, what does that mean? What does a full investing cycle mean? So really, to me, it's capturing the longer term play. And Gavin's, a master at this in terms of looking at basically kind of like the forest and then reviewing the trees as well, right? So I mean, maybe it's just because he's an artist and that kind of thing, but really kind of looking at the big picture. I mean, I think it was back in January, maybe, Gavin. It was certainly February when really you had made a comment about how like the biggest thing to get right this year would be the dollar, and boy, have you been correct. And again, it's Keith has reiterated that fact as well. It's been one of the core staples in the long book has been UUP, so that would be just long dollar. And man, I mean, year to date, I mean, that puppy has outperformed. I mean, the Dixie year to date is up 15.8% as of the weekend, so as of the end of the year. So if we pull that up on the chart here, since I can actually show you what I'm looking at. So dollars down here post the FOMC, which I guess kind of makes sense. But what an outperformer. I mean, that is the type of chart you want to see. So if you're looking at this on kind of on the live stream, I mean, that's a full investing cycle move, right? So we saw quad 4s on the horizon. This was something where we got long the dollar earlier this year, and we've really been able to kind of ride it out and buy the dips, and it's been an absolute outperformer. So that's really what the full cycle means. And again, it goes across the board. You can conversely on the flip side of that, you could say the full cycle on the short side could be QQQs or XLK. IWM, I mean, the list is quite long, right? So that's also kind of the full cycle investor. It goes both ways, but for many of you out there, it's, you really are long only. So it's challenging to get the full cycle on the short side. So in this market, really, there's been kind of really two places to be in terms of, positive year to date. And again, if you're doing this this work over the weekend, and now I got to like kind of incorporate, the TV screen here or the camera. But this is what the weekend work looks like, right? It's year to date returns. It's 1 month, 3 month. It's trying to capture, understand where is sort of what's happening with price, where are we coming from, and where could we go. And so the XLE, I mean, year to date XLE, as again, this is Friday, so I can pull it up as of today. But this is kind of this call is about assessing what we were looking at over the weekend and then where we are today on Wednesday. So an XLE really hasn't changed. It's basically plus 60% year to date, which is an absolute, it's been really the only year to date positive, I believe, from a U.S. sector standpoint. To date. So those kind of the three things on my mind, Jimmy. I know you've been up here, so thanks again for joining. Hopefully the West Coast is treating you well. I know it's 11 a.m. out west, so going to keep you entertained for the rest of the afternoon, right, Jimmy?
Hell yeah. Are we allowed to drop some F-bombs on this show?
Well, I think my mom's listening.
You're the moderator
I think my mom's listening, so I'm personally going to try to keep it clean. But yeah, it was pretty funny, Jimmy. She texted me last night, and she was like, "Oh, I had coffee. I had coffee with our old friends. That she's in Charlotte visiting my sister, and so she's like, I had coffee with with Tracy." And I was like, "Oh my gosh, it's amazing! Yeah, she's going to tune in, and she's going to get her parents on and stuff like that." So I was like, "Okay, I guess I got to make sure I got a clean show today, right, Jimmy?" So
sounds good. Yeah.
Yeah.
I'm just listening today. This is your inaugural live stream. I don't actually know if there's like a delay between the Twitter Spaces and the YouTube. But I know you got an agenda you want to run through.
There's a slight one. Yeah, no, but I mean, again, this is about the notebook, right? So kind of coming into this afternoon.
Yep.
This is the first time we've done it in real time with market open, which is a little bit different. Again, we're not really day trade, or like I'm certainly not a day trader, although I do trade daily or quite frequently. But so again, this is like a little bit new. So if anybody's out there listening in, they gotta, they have general, kind of, again, let's keep it to the notebook and keep it to sort of signals that we're seeing. But really, the big signal to me remains the fact that, we are, from the top left to the bottom right, and the bear market bounce, sure, it's a bounce, but at the end of the day, how do you want to be positioned to capture that full investing cycle? And it's very possible that it's going to keep going lower, at least from our models.
It's hard to disagree with that.
Yeah.
I mean, I think we've talked about the last maybe 2 or 3 weeks now on the weekly notebook review, the difference between the trade duration, where we've seen this counter trend bounce, we've seen, the Dixie give back a little bit, versus the tail and trend duration, where the dollar is still in a bullish consolidation, right? It's been making higher lows, and at least right now the dollar's off post FOMC, but there's still a lot of elevated volatility nearby. I mean, in the near term, we talked about some of the divergences, in small caps. Crypto is a function of maybe index constitution. Really, if you think about the liquidity that was pulled out of the system from last year to this year, a lot of small caps have gone to zero effectively. It's when you're down 60, 70, 80% and the people are fleeing, and now the generals are shot, the market structure is still quite poor. So a lot of my favorite small caps are now up over 60% from the bottom, but that really doesn't say much, right? How much are they down from the all-time high? So sticking with the cycle, I would have been able to buy a lot more shares, and I think a lot of you guys too. But it's still mindful we're not quite out of the woods. Whether people talk about, Santa rallies, blah, 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 this and that, midterms, blah, 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 this and that. I think a lot of us are focused on the volatility, on the dollar, on the yield. I wish I could have executed a little bit more on those bonds. I was like, I'm going to wait till it gets to 387. I'm going to short it. Something like that, right? We got down to maybe 393, 390-ish. So that remains to be seen. But sometimes the best thing to do is just to do nothing right now, to let this kind of play out just a little bit. There are moments in time. I don't think we're quite at the August levels. I mean, clearly we're at a lower high on the S&P on a bunch of metrics. But I get a lot of questions too about, hey, when are you going to go short, or how not to go short too much and lose our shirt. I know I've had trouble like hanging on to my shorts. Just when I don't think they'll ever hit the low end of the range, I sell, I go to minimum and then they crash, and vice versa. This whole quote unquote melt up. A lot of people have been incrementally shorting, but VIX was in the 30s. Anything can happen. But I think a lot of people pointed out trade to trend to tail, some of those really big shark lines. There's some pain, and we haven't seen that capitulation from the bears. But we'll see. That's all just more near term.
I wanted to add there one interesting observation. For the last 16 trading sessions, VIX and VIXN have ticked down. 16 trading sessions they have ticked down, right? There's some systematic investment or systematic wall selling that is happening by the specific set of flows that come in from almost insurance-like companies or market makers. Even today, I understand because the event actually materialized and we don't necessarily have a huge uncertainty that is related to this. But, when I look my side screen, like one of my 5 monitors, it's loaded with, at the top, there's ES and NQ side by side. Right below that, there's the VIX and VIXN side by side. Right below that, there's the AD-SPD and AD-NDD, which is the advanced decline number of issues side by side. And then finally, Bitcoin and ADD side by side. So when I look at that, we're kind of getting into the fade mode for today. We had a great sort of a melt up. We're getting back to the VWAP, which on NQ is 11,303, on E-minis is 3,856, and AD-SPD and AD-NDD are kind of, they shot out significantly. Suddenly we had like 300 plus S&P 500 components which had gone up. So we were at minus 50 just before 2 o'clock, and at 2 o'clock we shot up to 200 on AD-SPD. Now, coming back from process perspective, in relative strength perspective right now, on a daily basis, financials, industrials, and energy are outpacing others, such as real estate, communications, and so on. But I just wanted to touch upon specifically the VIX and the VIXN observation that I had. And I'll make some other observations later on. Back to you, Jimmy.
Yeah, appreciate it, Tron. Yeah, I mean, I think, again, volatility, if you just kind of go through the numbers even this morning, right? Like, it's all still like it's in the chop bucket, right? And so this is where when you're in the chop bucket or you're in the F bucket. So for those that don't know that terminology, chop bucket is 20 to 29. F bucket is 29 and higher for the VIX, right? So it's pretty much the same for the VIXN and RVX. But when you're squarely in either of those, moves to the upside and downside are elevated, are going to be exacerbated as well, right? So, a 2 to 3% move is really pretty much standard for when you're certainly in the F bucket, and so these big swings are not uncommon, but they are basically a reiteration of the environment that we're in. And so again, I'm just going to keep reiterating that we are in a quad 4. Prepare your portfolio for a quad 4 environment. And if you have not, taken down your tech, your consumer staples, your consumer discretionary, and other, retail, other type of kind of consumer oriented exposures, then, this quote unquote bear market rally is a great opportunity to do so. If the other kind of data point too is, the NASDAQ, the comp Q is up 33.3%, in the last 3 years. The Russell's up 17.5. SPYs are 28.3. So the tail risk here is very much in play. And so again, I'm just going to reiterate that, right? So be conscientious. A lot of us are very focused on, or many folks out there, especially on Twitter, are very focused on the immediate term, right? On the trade duration. But capturing that full investing cycle, this is the difference in like the Hedgeye process. It's going from a complete end to end in terms of, it wasn't even being early. We just saw the signal in, say, inflation back in Q2 of 2020. And we rode that thing all the way up, right? We rode commodities. We were long corn. We were long soybean, wheat, oil, et cetera, right? And now we're seeing the kind of opposite of that a little bit. It's still, but the thing is it's still sticky and elevated inflation, right? So, I mean, it's 8%, right? We got it going down to, I think the model has it to about 4% or so over the next couple quarters. And so that's still very much elevated compared to where we were coming into in 2019. So just let those things play in, right? These are the data points that we need to be paying attention to. And the GDP numbers, in fact, I know Keith talked about it on the macro show yesterday or maybe Monday. Let me find that because I know it's going negative, but I want to quote the actual right number. Sorry. There's a lot of notes in here. I'll come back to it because I can't quite seem to find it. But that's okay. It's going from, it's going negative. That's the main key thing. So with that, Gavin, maybe I'll pass it over to you, buddy, and talk about what's jumping out at you today, buddy.
What's up, man?
I'm good. I'm great, actually.
Yeah. Sorry, I'm just it's just kind of like I just wanted to pop on and say hello, and I'll probably end up trading the close here, but we'll see once he opens his mouth if these moves continue or what. It's pretty interesting what's going on with the yield curve, though. Like the initial reaction is like 2 is down, 8-9 basis points, and the 30 years up, and then oil's up. That's still like my open question, like I know Keith, I think he said something on the macro show today about the higher low in the risk range on oil. Didn't he say that today?
Today was the broke through trade. So trade was 86.48 on oil. So it broke through there. I believe it's holding it, isn't it?
It's up like let's see.
Yeah. So
it's up about
2%.
Yeah. So
it's at the top of the range.
Yeah, it's pushing the top end of the risk range right now. But no, I mean that's a good thing, right? I mean, typically what happens when if it breaks through trade, as you know, Gavin, and holds it, typically it does move. It's kind of like a magnet up towards the trend line, which I don't know where that is, but
all good. I mean, it's just kind of just a normal day. Like, everything was kind of like gridlocked up until, the decision, and then markets got kind of, freed up a bit. So now we have the dollar down, like, it's not even that big of a move, 0.7%, compared to what it could be, but, it's something, so I'm just, I'm still building out positioning, and so we'll see what the prices do into, 3:00. So.
Yeah. Did you see the? Sorry, go ahead, Trey.
Good. No. Finish it up. Sorry, I didn't mean to interrupt.
No, Gavin, I was just going to say, did you see the kind of new addition that Coach added this morning in his PA to the minimum size?
What was that?
XLP.
Oh yeah. The weekend work actually. What did I have? I had XLV and XLP kind of popping out to me this weekend.
Agreed.
Yeah.
Agreed. Yeah.
Both of them were like, and I mean, it's like, it's not like they haven't popped out before. I mean, they're sectors that could do well in this type of environment, or not do well, but just like outperform. Right. So, but they kind of pop back
traditionally
out.
Back tested positively in a quad 4 environment.
Right. Yeah. So that's interesting. Put that on there. Yeah. I was actually like, energy is, we'll see how it closes the day, but it's like kind of on my radar for, I still think it's like just dominating, but maybe it can slow down for a little bit.
Yeah,
we'll
but I mean,
see.
if you look at the earnings growth this quarter, I mean, they're putting up plus 160, it's basically 160%, earnings growth, right? I believe that's year-over-year basis, and I mean, like again, typically the signal front runs the actual data that comes out. You know what I mean? So it's kind of that to me is a classic kind of data point there in terms of. Like the signal sniffed out these great earnings, and the fact that elevated pricing in oil and energy in particular is obviously positive for margins, which is when you say it in that way, it's kind of a no-brainer.
Yeah.
Yeah.
But yeah, man, thanks for doing this. I just wanted to pop on quick, and
Yeah, man.
I'll probably have to split, but I just wanted to say hello.
Appreciate it. Trent, back to you.
Yeah, I was gonna add that. Did everyone see the pitch? And this is a pitch for all the listeners. If you haven't seen the pitch, definitely look at it. The reason I'm bringing that up is because I've been doing a lot of research on some of these names in the home improvement side. Home Depot, Lowe's, F&D. I've been doing some channel checks. I'm also looking at some website traffic data, and also doing some other research. By the way, before I continue, Rob, am I clear today, or
you are much better? You were a little fuzzy earlier, but you're clear as a bell right now.
Okay, thank you.
Thank you.
Yeah, because last time when I heard the recording, I felt really bad. So apologies for everyone.
Don't worry about it.
Yeah, so going back to this part regarding Home Depot, which is Brian Mago's top short in the pitch, as well as Lowe's, and then the third one being FND. So Frank, Nancy, Delta. And I know I got N wrong, but Rob, keep me real here, right? FND. So this is for home improvement related aspects. These things, as soon as the results come out, either this quarter or next, are not going to have a good time. So the way I'm structuring my trades, and this is not an advice for anyone, the way I'm structuring my trades for Home Depot, let's say, is I'm starting to build some put vertical positions targeting this around January, and then also around the results for the next quarter, which is the Q4 of 2022 coming out in Q1 of 2023. So, and the way I'm structuring it is at the money puts, long, short, about 10% on the price front, or on the delta front, about 40 or 35 delta puts. The reason being, right now these things are trading at close to 40% of their full possible payout. And as and when this thesis turns out, so I'm starting off with like a 20 basis points each kind of position. So just to be clear, on Home Depot, it's 295 to 70 put vertical. And I'll be building upon that as we go towards, as Home Depot starts going up because of the seasonally bullish time frame, towards 320. At 320, I'll have to lighten up as some sort of a risk management measure. But because 320 onwards, it starts giving a slight different signal, at least for me and my models. But I'll re-enter them as and when Home Depot comes back below 320. As of right now, Home Depot is 299, and that allows me to build some positions. So what are the catalysts here? First is this quarter's results. Second is as more and more mortgage data comes out, it will be very clear that consumers won't be able to do what they're doing for the last 2 years, that they were dipping into their HELOCs and trying to get more and more home improvement done. Some of them are trying to sell, and they're in like the last leg of home improvement so that they can sell it at a better price. But even if they're trying to sell, they're asking for a certain price, and the bids are far lower in the real estate market. So going back, Home Depot, Lowe's, F&D, these are giving me some very interesting ideas at the moment. And on the country front, some of my favorite ones are EWG, EWO, and EWI. So those are the ones where I'm trying to build as we get into the seasonally bullish time frame from a standpoint. And when I say EWO, that's Austria. It's at 70.4. In that one, I'm not doing any puts or put verticals. I'm just directly holding short stocks. So those are some of my thoughts on countries as well as some specific sectors. Back to you, Rob.
Yeah, just on that from a country standpoint, Coach mentioned EWA and EWY today, so that'd be Australia and the Kospi, and you hit the button on EWY. So that kind of tells you, should tell you basically, this couple day bounce in Asia, as he said this morning, really unlikely has legs. So, but Europe continues to be one that we, that just the one that to me, Trend, that really the financials there, EUFN, that one. That one's pretty much top of one of the top of my list, that's for sure. But to your point, Trend, on the pitch. So this is a good segue or back to it in terms of the pitch was 10 analysts, 10 stock calls, call it, quote unquote stock calls, and it happened yesterday. So it's free. You can find it on hedgeye.com. And one of the ones, Howard, who's listening in here, Howard Penny, who's the restaurant analyst here for Hedgeye. His pitch was Domino's, right? So that's again, there's always ways to kind of pair things off. Trends kind of looking at things on more of a I guess short side of whatnot, but DPZ again, if you just look at today, it's up 4%. I'm assuming post FOMC, but regardless, there's longs to have on the flip side of that, right? So one of the other ones was DraftKings from Todd Jordan, and again, I don't know what it's doing today, but it doesn't really matter what it's doing today. It's about kind of capturing the full cycle and kind of the call in DPZ, or it's not even a call. It's just the research, the data, the analysis that Howard does, which is some of the best around. It works well. He's run through the back test. It works well in multiple environments, but certainly in a quad 4. And then there's other fundamental catalysts as well. So definitely go through that pitch. It's excellent use of an hour of your time. And again, just want to welcome kind of anybody who's listening in on YouTube or watching on YouTube. Again, just the kind of benefit of that versus just the Twitter Spaces is, you've got you can kind of see my screen. So I'm pulling up a couple different stock charts. Like for instance, right now I have Domino's Pizza on, and yeah, so just kind of another way of sort of consuming or being able to leverage this content as well as on hedgeye.com. So again, thanks everybody for tuning in.
Cool, Rob. I must say that this combination is pretty cool because I just saw that at the right bottom in the live stream, it actually showed that box about the replay for the Hedgeye the pitch. So this actually becomes far more interactive and easy to consume, not just an audio, but you now get a visual where you can flip through charts, you can flip through all the risk ranges, you can flip through some of the materials we have. This is pretty cool.
I'm glad you like it, Trent. Yeah, definitely. I believe this is probably the first ever combo of kind of having spaces as the audio and but leveraging different facets. So a big shout out to Eric Genron and the whole team here at Hedgeye. This is again one of the beauties of me coming in house and have being able to put on the Hedgeye jersey is being able to provide this more elevated kind of level of content. And again, we're going to do a subscriber only show, a brand new show on Friday at 11:30. It'll be in the arena. So if you're not familiar with the arena, make sure you kind of familiar yourself a little bit. It's on, if you're a subscriber, you just log in, and it's kind of on part of the drop-down menu. So it's going to be live in there. It's 11:30. It's called Hedgeye Nation: A Beginner's Guide, and we're going to go through some questions that we didn't get a chance to answer on the macro show. That kind of that Jonesy didn't elevate or just didn't get time to answer, and then a top clip of the week from Keith, and then obviously just answering some of your own questions, so kind of a bit of an ask me anything type environment to wrap it up. But I just want to kind of put that out there as well. All right, well why don't we obviously, we've kind of said, I think, our piece again. Probably, I suspect, maybe the calmest spaces on an FOMC at 235. Trend. I'm sure you put in some limit orders here and there. If I know you, I've gotten to know you. I've gotten to know you pretty well over the last 18 months. So I suspect you had some limit orders in. I may have had a few myself.
I had limit orders.
Yeah. So with that, why don't we open it up? I see some, obviously, whether you're a friendly face or a newbie out there. Eric, if there are any questions on YouTube or on Hedgeye, that kind of pop up, I don't know if that's something that we're doing today. But Eric, if you just need, you can text me or whatever, I'll figure it out. But obviously here, guys, we got new requests. So so just jump up. Let's get into it. We'll get into the process and the notebook.
I think Jeff G and YouTube has a question of HD target. So Jeff, as I mentioned, my put verticals are for 295 to 75, but this is not the official Hedgeye call. I think you should go through the pitch to find out exactly what was mentioned by McGroarty. Knowing what I know of McGroarty, he actually usually never makes a pitch for 2 or 3 or 5%, like the trade I'm constructing. He usually goes for the jugular. He goes for like multiple handles of P multiple contraction or EV to EBITDA contraction, as well as the pod 1 and pod 2 analysis. So I would highly recommend going through the pitch and looking at Home Depot. I'm just making a very tactical trade from options perspective, such that my exposure is limited, but I do have slightly better risk reward than 1:1. Back to you.
Yeah, no, good point, Trent. And again, that's a good segue. The pitch is obviously free, and it is sort of a 5-minute rundown from each analyst. If you want to learn more about their kind of deeper dive call, obviously, either shoot an email to support@hedgeye.com, and they'll be able to coordinate a pro subscription. So for Penny, that actually gets you 3 different. So you get cannabis, restaurants, and consumer staples. So that's a pretty nice 3-for-1 type deal. And then with McGough, you get his awesome team and everybody, pretty much all the analysts have a pro subscription where you get a lot of deep dive research into the tickers that they cover, or the companies that they cover, excuse me. I think in tickers. I've turned into a trader rather than a research analyst, and Trend. So anyway, we got a few folks up here. So Raj, welcome. How you doing, buddy? Welcome back.
Good. Kind of working right now, but trying to sneak in a little bit.
Thanks for popping in. Yeah, thanks.
Just a quick notice. EWW. I know we talked about it last week. I think Owl mentioned it, so it kind of flagged a little bit for me. But right now, I'm looking at it today. I'm like, why wouldn't this be a good short today? That's all. I don't know if Coach mentioned it or anything. Because I'm not always online, and I'm looking at ETF Pro. And I'm like, well, it's a short, so why not? Today's like a good day to short, I think.
Yeah, he didn't. It's still on RTAs. So he's still on RTAs. He's hit the button twice on that, and yes, I mean, listen, I think the Mexican US dollar. Oh, sorry. The FX, I think, has played a bit of a factor there, Raj, in terms of just how FX can impact the US listed equities themselves, right? The ETF. But again, I mean, the quad outlook is quad force for Mexico, and a stronger US dollar is likely, is what we're seeing in the future, right, Raj? So I would agree without. I would agree. I think
I'm just thinking about taking a position here now and starting a position, and knowing I agree with that the FX portion of it, but start building this one, I think. So I don't know. It's just a thought.
Yeah. Again, I mean, sometimes with these, Raj, personally, I kind of let them settle down a little bit, right? In terms of if it is going to be a bit of a phase transition, then having the position sizing right. It sounds like you're just entering it into position, so I think you're doing it, possibly, probably kind of like the right way, right? In terms of being, again, kind of having some on so that you can sort of figure out which way it's going to go. But that would be my only kind of some of these where the signal kind of is not quite as clear cut in terms of, bearish trade and trend. That's typically how I'll do it. And again, I know I'm not telling you anything differently because you're an absolute Jedi. But that would be just for those listening in. If you're pulling up EWW, yes, we're bearish on basically Mexico's country in quad fours, bearish in general. It's bearish trend. But again, it's just sort of from a sizing standpoint, if it's sort of moving against you, just sort of be conscientious of what you do there. That's all I'd say.
Yeah. Okay. That's all. I was just kind of curious.
Cool. But man, Thanks. Yeah. I mean, listen, Keith's got it on RTAs. To me, that's a green light, man. If it's going to the top end of the range, that's a green light to short more. Absolutely green light, right? Awesome. I don't know who. Hedgehog.
Yeah.
Welcome.
Hey, Rob. Thanks a lot.
Absolutely.
Hey, just on EWW, I've been watching that one, and the short interest has been fairly high on that. So,
gotcha.
I don't know if that's a factor. That's a factor I'm thinking about in terms of seeing that turn a little before I go in on that one. But my question was, Jib made a comment about he's having trouble holding on to his shorts.
Mm-hmm.
And that's something I've been struggling with as well. And I haven't really heard Keith talk about this process-wise, but I was curious how you guys think about that, whether to cut your losses versus don't being the weak-handed Hedgeye and carry on in quad four. So if anybody...
Thank you, Ben. So I'll give some idea of how I try to tackle that situation. It's not easy, right? And I think since August, I've been sharing this, that I've had a very large cash position. That's predominantly because from a collateralizing perspective against my put verticals, and also just to preserve my gains, because this was a Fed gift in a reverse order, right? Like last 2 years were Fed gift in the long side. This is Fed gift on the short side, as well as Hedgeye gift, let's call it that way, right? So first things first, any short position, I'm trying to make sure, especially short positions expressed through put verticals, are not more than 150 to 200 basis points. That's my general rule of thumb for the moment. The second part, and that's the largest, right? I start incrementally at 20 basis points and then keep adding 20 basis points. Second part is, where's the point that in my put verticals I may bail out? Usually at about 50%, and especially if less than 1 month is remaining in the put verticals, then I'll bail out on them, because I've observed in my past experience, as well as through some of the back testing, that usually when my put verticals go under by more than 50%, and just with 4 weeks remaining, they have a very tough time coming back up within a 4-week period back to being double almost to give me any sort of break even. So I don't have any sunk cost fallacy. I just bail on them, and it's okay, because typically, let's say by that time, if I would have built up a 80 or 100 basis point position and I'm losing 50 basis points, that's better than losing the whole 100. But if there's time left on it, then I would actually carry them forward. Next, for the stocks positions, right? Typically, I would bear my short positions on, meaning something which is meaningful, like 2, 3, 4% of the portfolio, on stuff that does not have beta of more than 1.2. I'll repeat that. So for my stocks short position, where I hold larger position size of 2, 3, 4%, or anything about 2%, I won't have it on stocks which is more than 1.2 beta with appropriate stop loss, right? So that's another risk management measure I use. For anything which has more than 1.2 beta, especially in like the 1.8 and above range, I would not let that position be more than 50 or 80 basis points, even in stock terms. So given all this, you may ask me how many positions I hold. I typically am comfortable with 60 to 80 positions. This is including both the long, short, the merger ops, everything. So that's one thing I would share with you, Hedgehog. Back to you, Hedgehog, if you have any follow-on questions, or back to you, Rob, if you want to take it to a different direction.
Yeah, that's a great way to think about it. When you talk about put verticals, how are you structuring that?
So at the money is a long leg, right? So that's 50 delta. And typically 2 to 3 months out, or maybe depending on catalyst, how I described to you about the Home Depot. And to make sure that I'm not crushed by the wall crush or theta as much, I do try to short meaning the short leg of the put vertical would be at around 30 or 35 delta. So it's 50-30 put vertical on delta side with 2 to 3 months out. Does that help?
Yeah, that helps a lot. Thanks a lot.
Cool.
Awesome. Yeah, hopefully, did that help a lot, Hedgehog?
Yeah, that was good. If you didn't have anyone else, I had heard somebody mention.
All I was going to add is just from a sizing standpoint, I think Trent kind of added this at the beginning or talked about it kind of in passing in terms of, I think he said he adds about 20 bips at a time. I think that's really, really crucial, right? So position sizing and timing we've talked at length about on this call, and I think that's again one of the perhaps hardest things to do, but one of the most impactful from a alpha generating standpoint, and that goes both ways. Not just adding it, but also executing on the top end or low end of the range in terms of either covering or selling some. It's something that I still have to be very disciplined on, right? And some days the days get very busy, so that's where kind of it can be very challenging, right? So again, just want to kind of reiterate that, but the sizing of a position, especially with elevated volatility, you've got to basically, size accordingly. When you got elevated vol, especially if you're long, if you set your traditional position sizing, right? So let's just say it's 6%. If we follow kind of Keith's logic or kind of the way Keith has communicated it, when you got 30 vol, a long equity position might only be 3 to 4%. Now again, but you have to figure out what's right for your own portfolios, and similarly on the flip side of that, right? So if you're only 3 to 4% on a long side from an equity standpoint, then kind of decreasing your overall rather than thinking about a short's going to be 3% as my max. Maybe it only gets to 1 or 1.5, right? But you maybe have a bit more of a basket of shorts like across the board, kind of like what you see in ETF Pro, and just the number of shorts that are available to you, and you're kind of rotating inventory a bit more frequently.
Yeah, that's certainly something I've struggled with as well. You get a clear bottom of the end of the range, or the temptation is to kind of jump in higher basis points, and you got to kind of execute that discipline, like you said.
Yeah. No. When we go with your follow-up question,
it's not easy because bear market rallies are really bad. Sorry.
No, go ahead, Trent. No,
so it's not easy, okay, because I don't know how actively you're trading. For what I described, I literally have to put in 5 hours or more every day just analyzing, not executing. I'm talking just analyzing, right? And then it's a lot of work. And that's why, since August, I had a new entrant in my family, I couldn't give as much time. That's why I've been more than 50% cash. So that's another thing to be mindful of, that if there's going to be some other priorities in life that are coming up, just degross, right? Don't worry about degrossing. Opportunities will arise later, but degross, because I'm telling you, man, if I did not degross at that point of time, I would have lost a substantial sum of money just not being degrossed. So both on my long and short side, I kind of took the money out. I said, okay, this is Fed's gift. Just let's preserve it. I don't mind paying taxes, so I don't want to be like the people who say, oh, I don't want to pay taxes, so I'm not going to sell. And they never got a chance to create a taxable event. So just definitely I highly recommend that your level of activity should be proportionate to the amount of active management that you can put in based upon your bandwidth availability. In addition, I just want to give a quick alert to everyone. Markets are heading down. I'm seeing Tesla hitting the low of the days, NQ's hitting the low of the days. We have hit the minus 2 standard deviation on the VWAP band. I'm seeing Amazon hitting 52-week lows, Google heading there. So, guys, at the beginning of this call, as Rob was saying,
check out UUP.
There you go, UUP also doing really well. So, as Rob was saying, stick to the process. Don't get sucked in the FOMO. NQ is hitting 11,165 and heading lower. I'm sure Powell is saying something, but check out your screens.
Richie just slacked me. He said the implied rate hikes have stayed completely flat, aka no change in anything at all. So pretty much all this hoopla and hullabaloo, whatever that is. It's all for naught. I mean, just stick with what we're doing. This is the absolute. We are generating alpha. We're the leaders of the pack, and we don't have to apologize for it, right? We put a shit ton of work into it. Oh, sorry, Mom. We put a lot of work into what we do. We grind every day, and this is the beauty of it, right? When we get to see, Brian, you just mentioned dollar. When we see core positions performing and scoring goals on the ice or the field or however you want to, whatever analogy you want to use, it's very rewarding. So just keep doing what you're doing, and I'm certainly here to help, and I'm going to keep helping, and hopefully you don't get sick of me.
No, Rob, you're always welcome. We're not sick of you. We actually love this. So everyone
Amazing.
Show Rob the love, just hit your claps kind of icon. That will give him a good sense.
But Brian, you've been kind of quiet there. So why don't we throw it over to the Muni guy? I know you've got a deal. You got a deal tomorrow, right, bud?
Yeah. But before I go there, I just had it on my brain. Hanging out with UUP, yeah, you know me. So I actually love days like this because for me, it's all entertainment. It's sort of like just like watching I just put the screen up and everyone's all excited, and then everyone's like and so as soon as Powell spoke, I just looked at the screen and I saw the dollar that I just sold the other day at 30.06 was at 29.77. Like, I'll just add back what I just sold, and I just bought the dollar because it's trend bullish, and it's pretty easy to trade. It doesn't, it moves pretty slow, and now it's back up to 30. So, and I looked at the ETF Pro. I printed it out every Monday. I looked at the risk range, and the low end on the trend was 29.32. So it went down to 29.77. So I hit it again. So I think it's a kind of a good reason I'm bringing up UUP. It's kind of slow, and it's a good one to learn how to trade in and out of. I've been very successful trading UUP as opposed to maybe triple Qs. But so what I touch on a couple things that I've made notes on here. One is a lot of you have seen I've been tracking the risk ranges on the U.S. Treasury really closely. And so we had 39 lower highs in a row on the 10-year. And today was the first day that we went neutral. So we had a no change in the lower high today on the 10-year. So I'll be interested to see what the risk range is tomorrow. And then the move index comes out around 330 to 4. And I'm interested to see if the move index, what changes we see there. So those are the two things that I'm kind of tracking really, really closely because I really want to hit the turn in rates. That's something that's I'm really focused on. And there's a free I call her DDB now, so Daniel DiMartino Booth. So on her YouTube channel, she did an interview, said the Fed is not going to come save the housing market. And within the hour-long interview, she talks a lot about what she looks for, and she talks about the MOVE index, and I felt that it was very educational and helped me a lot. So in terms of me tracking the rates in the 10-year, I'm just continuing to monitor, and I'll share information out on Twitter as appropriate. And if you subscribe to the risk ranges, I'm happy to talk to you a little bit about what I'm seeing, and would recommend that people subscribe to the risk ranges if you want to play rates.
Yeah, so just to clarify, what you're referring to is the low end of the risk range was the same day over day, right?
Correct.
Okay. Yep.
Yeah. So
and that was
terminology
the first time that happened, and that was the first time it happened in how long? Sorry.
We had 39 consecutive days where we had a new lower high.
Oh, wow.
Trading days. Yeah. So every morning I've been tweeting out 38th consecutive day.
No, I've seen it.
39
I just hadn't. No, I see your tweets. I just hadn't.
Yeah, it's crazy.
I didn't realize it.
I keep getting these people asking me.
I've been writing down HL in my notebook for a long time. So,
Think about it. It is also coincidental with the VIX observation that I mentioned, right? Like VIXN for the last 16 trading sessions has been ticking lower. So there's definitely some sort of systematic play here, where maybe there's treasury departments or whatever, they're taking advantage of this elevated volatility, along with taking advantage of almost end is near sort of pricing of risk, which happened when we hit the VIX at such an elevated level about a month ago. And they decided, okay, we'll jump in and we'll try to sell some vol here. And it makes its way down to all of the risk assets, right? So it's not just the equities, but also treasury. So it's coincidental. So definitely it's not by chance. It's by cross-asset sort of portfolio management that is being done at very high level by fairly deeper pockets. So definitely something worth observing.
Yeah, and Robert, I may apologize. I may have called it wrong in the Hedgeye lingo. Is it high or low versus low or high?
It's a high or low.
Yeah, higher. Okay, so I've reversed it on my own somehow. But the low end of the range for the yield is meaning that it's moving up each day. So, so secondly, on mini rates,
it's correct. It's three. It was 3.86, 3.86 last week, and it's 3.90 today on a week-over-week basis. But it was 3.90 yesterday and 3.90 today.
Yeah, so it'd be interesting to see what it is tomorrow, because I know there's a lot of people.
I have a feeling it's going to regain its it's like 405. I think I just saw. 406. It's moving higher.
I agree with you.
Yeah, so I have a feeling as long as that move, you're right. The move's going to be interesting, but it's been trending up and to the right as well. So at 148, whew.
Yeah, the move is crazy.
Yeah, coach said it yesterday. He said, watch for that move greater than 160, and then watch what the market's going to do. So listen, stuff's not bad yet, like really bad.
Right. But a lot of people are trying to watching rates, and so I really want to focus on just a few things, and this is one of the things I chose to focus on. So on muni rates,
sorry, Brian, just on that in the yield curve too, Eric, the chart. So if you're on the YouTube or on Hedgeye, Eric's going to show a chart here of kind of the historical yield curve and where that has been over time. And so this is a very impactful, right? The yield curve remains, I think it's actually down at the moment to minus 50 or so bips. So this is, if you kind of go back, so it's actually kind of decreased a little bit. So if you go back in time, we had minus 51 in April of 2000. you go back to 82, minus 0.72. 89 was minus 0.44. As of this morning, or kind of the close as of yesterday, it was minus 0.46. So, the closing prices matter, and again, but it's not really, as of right now. It certainly isn't changing, and this is kind of the environment that we're in. So it remains in extreme lows, and that's not usually a very good thing.
Yep.
Yeah,
so
awesome.
so
Right,
looking at
Brian, back to munis.
Yep, back to muni rates. So we've been seeing some firming. I was on a JP Morgan hour-long market update yesterday. Also got some continuing education out of it. They see, and I'm seeing too in the secondary, there's kind of a firming up as the supply is drying up. It's not a whole lot of bonds in the secondary on some of the searches that I'm seeing like there was earlier in the week and then last week. There'll be fewer days to price the rest of this year because of the holidays and how they fall. So those days will be very heavy calendars, but then there'll be days where there's really kind of nothing. The one fund that I follow as a proxy is MAV. We saw it rally off the lows about 1% here today, and I see it's coming down a little bit here since the announcement. So that proxy seems to be following what we're seeing in the primary market. And then we're just seeing less supply overall in the secondary. So we continue to go from here to the end of the year. I think muni rates will firm up. Don't know if they'll change the yield very much, but I don't think we're going to see them move as aggressively as treasuries do, and they normally do not. And then lastly, so tomorrow morning, I have a deal in the market. If you go to #MuniDeal, I've put a number of tweets about this transaction, and I've done it so people can learn. Again, this is not advice. This is not saying buy this bond. This is simply for you to just learn how to buy a bond in the primary market. So one day that you want to do that, how this process works. But it took about a week, but the deal is on Fidelity now. It's on their platform. Should be on TD Ameritrade, but I don't have a contact there, so the underwriter's handling that. And then the priority orders, which is important because if the priority orders does not put retail first, then you usually don't get filled. Here, the priority of orders is retail first, and then member orders are institutional second. So would recommend for people that want to learn to go to Fidelity and go to the new issue and click all the way to the point to where you can put in your ticket and then don't just hit cancel. But by doing that, you'll learn the process for when one day you actually want to buy a particular municipal bond. You'll know how to do it in the primary market and at the initial reoffering price, not buying it in the secondary, not buying it from a broker that's marked it up 2 points. And so that's just a live deal for folks to monitor. But they will take orders until 11:30 tomorrow. We see it on the screen, and then we go through a finalization process, and we do what's called allotments. And so if I see an order from Nevada for 10 bonds because I got a message from somebody, that order will get filled because it's retail and they'll get their bonds. So just #MuniDeal has all that information. But that's really all I got, Rob. It's not a whole lot this week. And, excited it's got some UUP.
Yeah, you know me. That's great. And Brian, thanks for kind of jumping on and educating everybody on munis and sort of the process. So, if anybody's interested, again, feel free to either, he's also been making, he's made himself available as well. So, I think DM is probably your preferred. If you've got any questions, right, Brian?
Yeah, just DM me.
Yeah.
And if I'm not following you and I can't DM, just send me a little note and I'll send you a DM. And I'm happy to get on the phone too. I've had a number of phone calls with Hedgeye Nation, just asking questions and stuff. So I'm happy to help anybody out.
That's awesome. All right, so maybe another few minutes here. Anybody out in the crowd got any questions or follow-up commentary, stuff that's on their notebook or things they want to walk through? We'll open it up again. Jimmy, I know you've got some small caps in your portfolio, so I'm going to ask, how have you been maintaining those year to date? And, did you lighten up a little bit coming into this sort of bounce, or sort of this, or how are you handling it, buddy?
Good question. A couple have just taken to the chin, and now it's kind of at my throat. But for a lot of the ones that I like, I mentioned the liquidity rug pull earlier. There comes a point where when the names start trading below enterprise value, not just as a function of maybe fundamental bearishness or factor exposure bearishness, but really just a matter of liquidity, where there's no institutions left. Playboy, among a bunch of other names, right? It's kind of there. It's like, do I get heavier? At $3 a share, do I get heavier at these D-SPACs trading below cash? I joke that's like the backdoor cash allocation. If you want UUP, buy some D-SPACs below enterprise value. Cooper would attest to that. But it's there's like a bit of an 80-20 going on. So like I've hodled a lot of these names down, which has been painful. But in my trading accounts, I'll try to tactically trade around the risk ranges. They don't get published. I'll use Bollinger Bands sometimes, but again, frankly, the liquidity is so poor, right? It's like, however we build conviction, however our duration time frame is, the best way is to not look sometimes, because they can move 10, 20, 30% on the regular. And even trying to get 1,000 shares of something trading at $1, you'd be surprised at how illiquid it is. So that's harder, and so that really comes down to the short book, right? Can I short enough small caps? Can I short enough IWM? Can I short enough of these other names that are going down? And then I think a lot of my behavioral biases when it comes to covering too soon. I don't have a problem riding the shorts higher, because I still have a lot of long exposure in long only accounts, Roth, whatever, you name it. But when you see these names down 60, 70, 80, 90%, I do wonder like how much juice is there left. So there's kind of a balancing of mindsets where I'll be actively short. Yeah.
No, from a sizing standpoint on the short side, are you getting them to your kind of like your personal max position sizing, or how are you doing it from that standpoint from your portfolio?
In the past, I have, but now I just try to spread out my wings a little bit more, because like they run up and down with the market, so it's still a beta play, right? We're still not at the point where we're talking about the businesses, we're talking about fundamentals. We're not in the right quad for that, so it is what it is.
No,
happy to have that exposure. Certainly over the last
month or two. I meant on the short side. On the short side, are you getting your maxes there?
Yes,
because you were talking about letting things run, right? So like basically, something that Keith told me last week, and it's like it's at my min. I don't violate that rule, and therefore I'm not selling it. It was around energy, right? So it was cool to have that reiterated, because that's what he's preached, and that's what I've always known. But obviously, at least I've done it where I've violated rules all the time, really, but getting better at not violating them and my own personal rules. And so, but sticking with that, right? And again, this is a guy who's been trading and managing money for 20 plus years. So learning from that, and how regimented he is on those rules. And Trent's excellent at this too, and same with Gavin, and the list goes on. 1000RFX. I mean, he's one of the best I've ever seen, as well. And probably just because I've a bit more intimate with how he functions. But anyway, long story short is, I mean, like if you've got your in position sizing, right? If it's 50 or 75 basis points or 100, whatever it is, right? That should give you, in theory, right, the continued sort of leg down, while maintaining kind of that tactical, incremental kind of approach to covering some and then adding some back. So I guess my question is a little twofold. Are you getting to your max? And then two, when you're kind of in the middle of the range or sort of on a green day or red day, how are you handling that? Again, I'm not trying to put you on the spot, Jimmy. I'm just kind of curious as to, because it's likely a question or something that a lot of people are dealing with, especially now that if they're kind of recognizing, hey, this economy might not look so good, Fed's, tightening into slowdown, or what appears as this, anyway, the Fed's tightening into slowdown. What do I do with some of these, small caps or even tech names that, I didn't sell? And again, I'll reiterate, my thought process, which would be, take this opportunity to, capture any of the remaining gains or kind of to minimize the losses from here, in my humble opinion. But again, like, you can also do other things, to your point, Jimmy, like, keeping the longs, but adding shorts on the other side, right?
Yeah, I mean, you've asked the most important questions. I think when it comes to position sizing, because everyone has to stick to their own process, but I think Keith makes it look easy, and a lot of new subscribers, including myself, post-pandemic and all that, and trying to ditch the old wall baggage. It's like, we think the market's move in this normal distribution. So like at the top of the range, I've got a nice max position in the nice, bearish trade and trend names, but then it starts to move to the middle, and I still find myself like, oh, I should cover this. And then when I see the real-time alert, cover some. It's like, I'm glad he's starting to say some for a while now, but it's still like, I have this urge to just like book my profit. And inevitably I find myself, when it's in the bottom third of the range, wishing I had more exposure. All of us,
sure,
many of us, I think. And that's something that I think is just takes time and patience. I can tell you for sure, whether it's a retail day trader or someone like myself, it's like, there's the temptation to want to make money every single day, right? And not set up, but it's about the setups. So I'm still trying to get better at that. I think there's a lot for me to improve on, but yeah, I don't have a great answer. I'm still trying to get better myself.
No, Jimmy, it's a very good answer, and that's the raw, honest answer. To be perfect, like, so thank you for doing that, and then it'll be $100 for your therapy session. No, but Keith reiterated that today in terms of like, it's about the when and the where, right? So it's like, when are you executing, and where, in terms of like, where in the risk range are you executing? And those are the two huge components of doing it successfully. So no, keep at it, buddy. And again, like, I know you will, but yeah, man, hopefully for those listening in that maybe going through a similar thing, Jimmy was willing to share that. So X2, floor is yours.
Okay. Oh, sorry.
Raj, go ahead.
No, I just want to give encouragement to Jimmy there. I mean, it took me 9 years to do this thing here. First 4 or 5 years, it took me a while just to learn all this stuff. And now I'm kind of good. I understand where Keith is going. I could even think and how he thinks, and execute on my own. But it takes time to do this. You have to go through a couple of cycles to understand what's happening and what's not happening. And like today, for me, today's like a fun day. Like, I'm just making money because I know what Keith's doing. He's just selling some of these on the real-time alerts too. And I'm selling all whatever profits I had. I'm just like, all right, take something off. So, but it takes a lot of practice on it. Part of the thing I think Trent was saying earlier was also that having a lot of cash on hand, that's also pretty good, because when you're learning, when you make a mistake, I mean, you want that extra cash to be on the right side again. Even though when it's going against you, you buy more, even though your instincts don't tell you to. But that's something you got to learn to do. And until you really get to know how this process truly works, you want to keep your risk down to a minimum a little bit. So that's it. I got to go back.
Yeah, appreciate it, Raj. No, great commentary. X2, welcome.
Hey, Robert, congratulations.
Thank you.
You made it the big time.
That's
We're very
right.
proud of you.
I'm in the studio and everything.
It's unbelievable. Unbelievable, really.
Yeah.
I just real quick, a couple of things for Jimmy. I saw a tweet earlier. Someone was talking about, I think it was Paul Tudor Jones, that said he would not trust anyone to manage his money who hadn't blown up at least once. So I think part of it is, that's the learning process. If you can't learn the same, lessons unless you've gone through it. So just take that for what it is, and whatever you do, Jimmy. Robert's mother is on the call. Don't talk about Playboy on here. Come on.
you mentioned it first. Actually, I did.
Anyway, I just wanted to say hi, congratulate you, and also just to say what a move, 200 pip round trip move on the dollar just now. It's, if you're not trading it, like Keith says, today is not a day to do nothing.
Oh yeah, it's the beauty. So we'll wrap up here in a few minutes so that everybody can go trade the close. But I saw Annalise came up as well. And XT, thanks for jumping up, man. I appreciate it. Looking forward to seeing you in Miami and finally putting a face to the name. But anyway, Annalise, welcome.
Hi, congratulations.
Thank you.
And since your mom's on the call, can we talk about Playgirl?
It's part of Playboy now.
Okay, I want to go back to. I'll take the applause offline here. I want to go back to something that Jimmy said and something that I've been thinking about through the prize, because I did the prize, and when I was doing the prize, about the last 5 days, I actually made it into the top 50%, which I'm so proud of myself that I got there.
That's awesome.
But I was consistently running what I would call the Mike Taylor book, where I was 90% short and 10% long, and I got somebody spanked me a little bit and said that was irresponsibly. Don't be irresponsibly short. And I've heard Keith say that too. And then I was listening to what Jimmy said about how, you're wanting to cover because you're wanting to take some of your profit off the table. And so what's the difference between being irresponsibly short and not covering and letting that ride a little bit? So I don't know if it's a ratio thing about, how many shorts you're having and how many you're not. And don't forget, it was the prize, you guys. I'm not doing this in real life. I was just learning how to short. So that's my question, and I'll drop off the mic.
Yeah, Annalise, I'm sure Trent, if you're around, you may probably have a response to this as well. But I mean, it is absolutely a ratio, right? So on that 10 long, called one long to 9 shorts. I mean, that's a pretty aggressive net short book. But again, I mean, if that's what you're comfortable with, then that's like the beauty of this game, right? Is that it's different for everybody, and everybody approaches it slightly differently. So yeah, I mean, I really think it totally depends on time horizon, risk profile, how much you trade, as Trent mentioned earlier, right? In terms of, how much can you touch the book? So yes, I mean, that's a tricky question, Annalise, to be perfectly frank with you, because there's no really right answer, right? I mean, if we use Keith as a guiding light here, his max net short would be, minus 25% net short. So again, I mean, to get to that ratio, it's your longs minus your shorts, right? So so that's kind of, again, that's how you get there. But for others, it might be, I think Pokey's on here. I'm pretty sure that Pokey takes it to minus 50. Mike Taylor said he gets out to minus 80. But again, Mike Taylor, you got to, sometimes he does incorporate the notional amount, right? So there's a bit of a difference, if he's using a lot of derivatives or futures trading and he's short in that market, that obviously,
okay, that's helpful. Yeah.
Yeah, so that also, so if he's again, so that's what he's on the hook for, right? If his short goes to expiry, but it's not necessarily how much he might have out like of actual dollars exposed on the short side, right? So I think there's a lot of, again, this is like a very nuanced question, Annalise. So for somebody who's getting started, the way that I would answer that question would be in an elevated volatility environment and where we have vol elevated across asset classes, whether it's the move, FX vol, VIX, VIXIN, OVX. I mean, everything is elevated, is in the elevated range, whether that be the chop bucket or the F bucket. I would have your capital exposure to a very conservative level. So trend.
Okay, that's helpful.
Yeah. So again, if you're going to make a mistake, as Raj just said, try to make sure that mistake is small, right? So
Yeah.
in terms of, again, I'll just use, I'm making up numbers here, but let's just say it's 75% is cash, and you're kind of quote unquote learning or putting another 25% to work in terms of a long short book. Now make sure you don't forget about the longs though, right? So there are longs to be had out there. So whether it be individual equities or something like an XLE that's been an absolute outperformer, on the page and has been bullish trade and trend for quite a while, right? So, those are things to be considered, right? To have that long short. And again, I'll just reiterate kind of like the when and where, like what were you doing yesterday at, when the U.S. Treasury, basically almost, the 10-year, ticked kind of the bottom end of the risk range, right? Were you trusting the process and shorting some TLT, and maybe buying some dollars right at the low end of the range, right? But or were you, trying to kind of play the pivot call and get long gold or something, right? From a real rate standpoint. So again, it's all dependent on kind of what you're doing, but the where and the when, to me, if you just focus on those two things and keep the list tight when you're learning, and so keep it, potentially keep it to just the risk ranges that get published daily. That should help you kind of focus on.
Okay.
So for instance, yes. So like Brian, for instance, he's learning, he's getting into a bit more of the equities, and he's really kind of focused on the Qs right at the moment, I believe, right, Brian? So
yes,
so this
Qs,
is where,
UUT.
he's basically, yeah. So he's kind of like learning or kind of expanding his repertoire into that, into that kind of that inventory, that piece of inventory.
Okay. Yeah, I'm
Yeah.
trying to keep everything that I'm doing down to just a few so I can really understand the correlations. As you guys know, the lingo, the vernacular, and some of the correlation stuff is still, a steep learning curve for me. So, but that was really helpful. I appreciate it. I think one thing for me was when I was.
So what I will say, Annalise, is, again, I'll plug, I guess, my own new show, which is on Friday at 11:30.
I will be there.
So it's a beginner's guide, right? So these are the type of questions, but this is, again, it's not like, so, I don't want, it's a beginner's guide. So it is sort of, for those that are kind of new to Hedgeye and that kind of stuff, but there's always, components to be learned. And I'm even learning every day. I make mistakes every day. I learn every day. There's always something to be improving upon in your own process. So whether you're a Hedgeye veteran, like Trend and many others who've been around since 2013, or like Jimmy and I who founded in 2020, or yourself who founded in the last sort of year or so, there's going to be kind of a breadth of questions and stuff like that. But it's a great example as to, this type of commentary or question, right, is a great thing for kind of that Ask Me Anything type segment on Friday.
Thank you.
Hey, Robert.
Yeah, you got it. Yeah, bud.
Let me add just a couple of things here. So, Annalise, what's worked for me here lately is the only things that I have been actively managing is UUP, triple Q, and then on rates, the short TTT. And so I don't do very many of them. But it's kind of easy to manage when you're only doing 3, and the RTAs start making a lot of sense when you're only kind of doing a few things. Like how Trend does 60 positions, like that's not where I'm at. I can't. That's way too much for me. So I'm only doing like 3 positions. Just and those are the ones I'm doing that I can intellectually manage, understand, and then tie them to the real-time alerts.
So are you directly shorting the Q, or are you taking a position with SQQQ?
Yes. So I subscribe to Macro Pro, and within Macro Pro, SQQQ is a symbol. It's 3 times levered. And so when I take a position to short triple Q, it's normally with the RTA, because Keith's really good about shorting Qs. If you go back, you'll see it only happens, like once a month or once every other month. I use the SQQQ in my IRA. It's in the Macro Pro subscription, and I fade it. So I just do very small, tiny little increments and make sure that I don't get faded. And then when it's time to close it out and rinse and repeat.
Yeah, okay, that's about what I'm doing also.
And remember too, though, that the comp Q risk range is the immediate term risk range that we get daily. So that is a proxy for QQQ. So just remember that piece too.
Yes.
Yeah.
Understood. Yeah.
Yep. Awesome.
All right. Thanks, guys.
Well, you got it, Annalise. Thank you. Appreciate you jumping up, and I'll see you Friday. But this has been a great call. So, we'll look for kind of some feedback and stuff like that. But the plan is to kind of have these at 2 p.m. on Wednesdays and kind of move the time frame up. I know it's sort of during the day for many, but the replays will be available, obviously here on Twitter and then on Hedgeye.com and on the Hedgeye YouTube channel as well. So, if we need to kind of pivot and stuff like that, we can. But this is sort of the tentative plan for now, unless I hear a lot of hollering from my amazing supporters out there. But hopefully everybody enjoyed today's session and enjoyed the kind of extra live interaction with the screen and stuff like that. But again, thanks everybody for jumping in and joining. I appreciate it, and we'll see you Friday. That's a paid subscription. And remember, I'm sure you've been bombarded with some emails, but November is Cyber Month. So if you've been kind of toying with any ideas in terms of joining the Hedgeye research team, in terms of like getting subscribing to their research, by all means take advantage of the great pricing that we got going on this month. With that, I will wrap up. I appreciate it.
Awesome, Robert.
Thank you, Robert.
Thank you.